Most people start investing completely backwards. They pick random stocks, crypto, or whatever their friend told them to buy. But before you invest a single pound, you need to understand the 4 building blocks of every portfolio. Because once you start and to understand these 4, investing suddenly becomes very, very simple. Hi everyone, I'm Francesca. Today we're breaking down the 4 main types of investments that exist in the financial markets. And once you understand these 4, you'll understand almost how every portfolio in the world is built. And if you're interested in one-on-one coaching, please feel free to schedule a call with me. I'm going to leave my calendar link. It's completely free of charge. We can get to know each other and I can already deliver a lot of value in that first free session. But without further ado, let's go. So the first product that you need to understand is stocks. So a stock is the simplest investment to understand. The key concept is that when you buy a stock, you're buying ownership in a company. So for example, Apple, Amazon, Microsoft, when the company grows, your investment grows. So when you're evaluating the stock, professional investors always ask questions like, do I understand how the company makes money? Do I believe in the management team? Does the company have a competitive advantage in the market? Is the company valued correctly by the market? So these are the same questions you would ask if you were buying the entire company. So effectively, when you're buying a stock, you are participating in the ownership of the stock. Of course, we don't buy enough stock to participate in the decision making. We're not on the board, of course, but it's the same exact principle. So this is why people make mistakes when they first buy stocks, because they don't really understand that. They just buy it because, there's hype, there's FOMO, there's people talking about this and that stock. But if you evaluate every single stock as if you were buying a company, because that's what you're doing, then it forces you to take a step back, slow down a little bit, and understand whether the investment you're making is actually something you believe in, or you're just doing it because the Reddit is telling you to buy this particular piece of stock. So this is the first key concept to understand. The second financial product that a lot of people use is bonds. So the key difference and the key concept for bonds is that bonds is lending money to people. So instead of owning a company, you're lending money, and you can lend money to either governments or a company. So we have government bonds. For example, governments issue bonds to borrow money from investors or their citizens most of the time as well, and in exchange they promise to pay you back the original amount you invested plus some interest. Government bonds are typically considered safer because when you make this lending, and you can think about it in your real life, right? If you give money to a friend, you are thinking, you're evaluating in your head, what is the likelihood that I will receive this money back from my friend? And so the less risky the investment, the more likely it is that you're going to receive this money back, the lower the interest that you get on lending the money in the first place, because as we know, higher risk, higher reward. So these are the government bonds. They have this functioning. It's the same functioning for corporate bonds, so money that you give to companies. However, as you know, or as you'll be able to guess, corporations are much more likely to fail as opposed to governments and to go bankrupt and not be able to fulfill their loan. So they offer higher interest rates to compensate for the higher risk that investors take. So there is an important relationship between bonds and stocks, which we analyzed before. When interest rates go up, bonds become more attractive and stocks often become less attractive, right? Because if you the difference with bonds is that there is a guarantee that you will receive that money back if you keep it until the fulfillment of the loan period. And so if you're guaranteed, let's say, to have let's give a crazy number, but like a guaranteed 7% yield on your bond, then there's no really an attractiveness to investing in the stock market where there is no guarantee. So this is often the link between the two financial products. Thirdly, we have funds. So funds pool money from many investors together. A professional fund manager then decides how to invest their money. So that is the key difference. They are actively managed as opposed to passively managed. Funds are good because they can offer diversification, which means your money is spread across investments, but they also come with some important problems. So many funds charge high fees because ultimately they sustain a company behind them, right? So it's a corporation that needs to payroll, pay employees. They have fixed costs, overhead costs, and so they charge you as the investor goes to cover those cash flows. There is also the risk of human error, right? Because very, very few active fund managers actually manage to beat the market, the overall market in the long term and for sustained periods of time. So this is something to keep in mind when you're evaluating and how to diversify. And the solution to that is ETFs, which stand for exchange traded funds. So ETFs ETFs combine the best parts of stocks and of funds. And to simply understand it is, an ETF is basically a basket of investments that trades like a stock. So you will find, for example, an ETF that buckets together all the tech stocks, so replicating the Nasdaq index. The Nasdaq index is an index where all the tech companies are listed, and so if you just wanted to buy that sector, you can buy the Nasdaq. An ETF is a way to purchase that for retail investors. So instead of buying individual companies one by one, you can buy a single ETF that holds hundreds or even thousands of companies. ETFs, of course, offer diversification, low costs, a passive management, right? Because you don't have a person that goes there and sells the ETF for you, and also simplicity. And because there's no active management, they have very, very low fees because you're not paying for anyone's payroll in that case. You're just paying for the actual product that you are investing in. So that's why ETFs has quietly become the foundation of modern investments. They were introduced in the 1980s, and honestly, this is one of the biggest, most revolutionizing inventions when it comes to personal finances, and really have the potential to create big wealth for retail investors like you and I. So in the next video, I'm actually going to show you why ETFs outperform most investing strategies and how you can analyze one in just a few minutes. So if you're interested in that, then subscribe, and I'll see you in the next video. Bye bye.